Cryptocurrency. No other topic in finance and economics today seems to generate as much emotion or misunderstanding. There are those who are highly opinionated, those who are confused, and a great many who are opinionated without realizing they are actually confused. Getting a grip on crypto and the broader category of digital currencies has taken on still more urgency because of recent developments, namely the crypto crash of early 2022, recently imposed crypto bans by governments like China and Russia, China's newly issued central bank digital currency, the digital yuan. Many aspects of crypto and digital currencies deserve informed discussion. Here we'll zero in on just these three headline developments that still can provide a meaningful snapshot of what's going on and where things are headed. Bitcoin, the world's benchmark cryptocurrency, approached an all-time high of nearly $70,000 in early November 2021. It had dropped below $35,000 by Friday, January 21st. Mere 2 months saw some $1.5 trillion in the value of Bitcoin and other cryptocurrencies wiped out, about half their combined value. January 21st earned the status of a financial Black Friday because of the severity of that one-day drop, which was more than 12% for Bitcoin alone. This effectively put an exclamation point to crypto's rapid 2-month decline. For the crash, many saw $100,000 as the next likely price level for Bitcoin. The good news for crypto enthusiasts is that there are reasonable explanations for the price drop. The bad news is that those explanations also illustrate inherent weaknesses in cryptocurrencies. Reason number 1, tech stocks. The crypto crash has paralleled big declines in technology stocks. The week of crypto's Black Friday coincided with the worst week for stocks since the start of the COVID-19 pandemic, with the tech sector especially hit hard. That at least puts crypto in good company. It reflects the asset being a genuine technology-based investment. But cryptocurrencies are supposed to function as a kind of safe haven, not another speculative technology play. Investors should have taken the money they pulled out of stocks into assets like Bitcoin. As Bitcoin redemptions were even more severe than stock liquidations, that shows the market is valuing cryptocurrencies as even more speculative and risky than the technology sector overall. Reason number 2, inflation. Part of the reason for the sell-off in technology stocks also relates to inflation, which in the U.S. has been running at a 40-year high. Here too, Bitcoin and other established cryptocurrencies should be an attractive place to put money as a hedge against inflation. By not attracting those inflation-driven inflows, crypto is again showing itself to be more akin to an object of short-term speculation than long-term investment. Reason 3, central banks. Crypto's Black Friday also came right after the U.S. Federal Reserve and Russia's central bank each issued papers about establishing their own central bank digital currencies, or CBDCs. The U.S. Fed's paper suggested that the United States is preparing to launch a U.S. dollar CBDC. The Russian paper is much briefer but stronger in its wording, not only reasserting Russia's plans to issue its own CBDC, but laying out government rationale for banning cryptocurrency trading as well as mining in Russia. Government-announced crypto bans expose a fundamental flaw in the idea promoted by some enthusiasts that cryptocurrencies are set to replace government-issued fiat currencies. Here's the harsh reality that crypto bans remind the markets about. For Bitcoin, Ethereum, or any other cryptocurrency to replace a fiat money requires a government willing to allow that to happen. In 2021, the world's second-largest economy, China, implemented a blanket ban on crypto trading and mining. With Russia now announcing that it is following China's lead, this trend in anti-crypto policies naturally drags down the appeal, reach, and usage of cryptocurrencies. While banning crypto, China and Russia are promoting their own central bank digital currencies. However, these CBDCs are not without their own limitations. For one, they are issued by a central authority, not distributed over a decentralized blockchain, which is a key benefit of cryptocurrencies. Secondly, they provide currency usage visibility to the governments that issue them. So the CBDCs offer more government control and less anonymity than even cash, meaning that in those regards, these CBDCs are the opposite of crypto. There is another factor other than greater government control that motivates governments like China and Russia to issue CBDCs. These countries are eager to globally promote the use of their digital currencies as part of a strategy to work around the U.S.-dominated international payment system known as SWIFT. This all fits into a greater geopolitical objective held by these modern authoritarian governments to diminish or supplant the global influence of the United States. Even with a long-held desire by China to knock down the power of the US dollar through its own currency, that objective is as unlikely as Bitcoin or another speculative cryptocurrency replacing the global influence of the American greenback. This is true even for a major growing economic power like we see with today's China. It isn't because the US dollar is inherently superior, nor is it because China's CBDC couldn't, in theory, replace the dollar. It's simply that China isn't willing to undertake the systemic reforms necessary to make its currency more globally powerful. This comes down to the way that China's ruling Communist Party obsesses over monetary control. Chinese authorities don't allow the nation's currency, the yuan, to freely trade in foreign exchange markets. That itself is a serious impediment to the yuan ever becoming a major currency of trade, whether it's in ordinary cash or a technologically advanced digital yuan. The most current statistics show the Chinese yuan ranking 8th in the world in terms of foreign exchange market turnover, amounting to a mere 4.3% of daily trading. That's less than the global share of the Swiss franc, Canadian dollar, or Australian dollar. The US dollar trades 20 times more than China's yuan. This kind of US dollar dominance has consistently held despite years of China's economy growing closer in size to the US, and with a consensus view that China likely will overtake the US in economic size within just a few years. A CBDC digital yuan will certainly help the Chinese currency's ease of use in global trading, but the impact will be only slight. China's closed capital account outright prohibits wide circulation of the yuan outside of China. There are other fundamental issues added to that. By international standards, China operates underdeveloped and highly politicized financial, regulatory, and legal systems, all of which are key to the possibility of a currency earning a major, let alone the biggest, share of foreign exchange. That is why, without radical change to China's overall economic structure, a souped-up CBDC digital yuan has little chance of coming anywhere close to replacing the role of the US dollar in the world. Crypto investors can take comfort knowing that the US and other members of the G10, which have the greatest influence in global finance, haven't, at least yet, signaled any plans to ban cryptocurrencies. But it's important to keep in mind something that most crypto enthusiasts fail to acknowledge. Apart from their transactional popularity at any given time, something economists call network effects, cryptocurrencies have no uniquely protectable underlying value. Stated plainly, they are worth something only as long as other people in sufficient numbers believe they are valuable. So far, even with seesawing market volatility, enough people want to pay and invest in cryptos. For now, it looks like their market value will increase over time. But how far they will increase is anyone's guess. So is the possibility that at some point they will crash out, like Dutch tulips and other famous market bubbles in history. While the long-term valuation of cryptocurrencies remains a massively open question, CBDCs are a digital currency of the future that represent a sure bet. In the big picture, governments themselves may come and go, but digital coins as a new form of cash represent a natural technological evolution for legal tender. Despite the anti-crypto policies adopted by China and Russia, the rise of CBDCs does not necessarily require the demise of cryptocurrencies. In most of the economic world, CBDCs and crypto will be allowed to develop side by side. China deserves credit for being a pioneer in the CBDC space and in digitizing its economy more generally. The nation is technologically far ahead of the US and many other economies in the realm of digital economics. But for all those advancements and China's growing economic size, it takes much more than that for a nation's coin to become a dominant currency in the global system. Till China fundamentally depoliticizes and opens up its economic structure, it frankly doesn't matter too much how advanced it gets with its digital yuan or international payments. If you found this info useful, please give the video a thumbs up. Comments and questions are always welcome, and make sure to subscribe if you'd like to stay regularly informed on topics like the ones covered today.